Hi, everybody. This is Lance from datatraders.com. In this video, I'm going to go over a hedge type play that I just made. I made it on 8/22, and you'll be seeing this video a little bit later. But datatraders.com members received access to this hedge. If you join any of the Data Traders plans, quarterly, lifetime, whatever you guys want, you will be getting access to this hedge type trade and the hedge channel for free included in your membership. So market went down a bit on 8/22. As of now, the market is down about 43 points. So SPX is down 0.78. Also, the volatility is up 8.7%. So these are good situations to be adding on a hedge type trade that I'm about to show. So what I did was I took MES and I sold an MES contract 57 days out, sold it at the 53.50 strike price, and I took in 45 credit. With some of that credit, I bought an ES put, same expiration for 2.25. So if you look at the math here, we sold it for 45. MES is a 5 multiplier. So I ended up selling and taking in $225 in premium for it. For the ES put that I bought was 2.25 times the 50 multiplier for ES, and I spent $112.50. So this is a net credit in the end if the MES expires worthless. However, it may not necessarily expire worthless, and I do have very specific management techniques I'm going to use for both the MES position and the ES position. If you have access to datatraders.com, you'll see exactly how we manage it. I wrote a management guide for it as well. In general, this position will do well if we have a big volatility spike or if the market drops a bit, while the MES position would lose value because we're closer to in the money. This premium will be more than 45 if that happens. However, the ES contract would be also worth more on big volatility spikes, just based on the Vega that we're adding Vega by buying the ES put. One ES put is worth 10 MES contracts in terms of the notional value. So because of that, the ES option could dramatically increase more than the loss of the MES contract. I'm going to be doing this in very specific time periods when we have a down day in the market and or an up day in the VIX. And this should help for hedging against big downturns in positions. Also, I do have other hedges like a VIX call hedge and bought ES put hedges with specific amounts of premium that I'm looking for. So again, don't want to make sure the volatility increases will significantly hurt my account. I do have set amount of buying power I'm going to use on my positions when volatility is at a low level. Currently, we are at a volatility of about 17.6. So it's still relatively low, but being able to enter in this VIX hedge on the big spike should help with volatility increases. Again, if you're interested, click a link in the comment down below. We get access to all my strategy guides if you're in quarterly plan or more, and you'll get access to this free hedge play. Again, last with datatraders.com. Hopefully you took a lot of interesting advice and being able to hedge your portfolios, and I'll see you guys on the next one.